If you're thinking about retiring from your small business but want to keep it in the family, you've got plenty of options. But where do you get started? At CSI, we've helped small business owners keep their companies in the family for over 50 years. We get how overwhelming this can be, which is why we're going to simplify things and focus on 4 popular methods to transfer your business to a loved one. Let's dive in. First up, the sale method. This is by far the most popular transfer method, even within family businesses. It involves selling the business at fair market value, often through a structured purchase agreement. It can be either a stock or asset sale, but stock sales are most common. The sale method is the most beneficial to you because small business owners don't generate most of their personal wealth through running their business. They gain it through the sale of their business when they retire. The sale is structured as money up front, payments over time, or a combination of the two, depending on what is outlined in the purchase agreement. However, these payments may be subject to capital gains taxes. This method can also benefit the buyer because they don't pay any taxes on the sale, and they can make payments over time through a loan if they don't have cash up front. If you're interested in using this method, your accountant can help you. We've done this many times for our clients at CSI. Next up, the gift method, which is the second most popular. It doesn't involve exchanging money. Instead, the business is a gift in the form of stock or assets. A downside is that you won't generate any retirement revenue like you would with the sale method. This is often done as a reward when the recipient has put years of their own sweat into the business. Customers don't really notice a change in ownership because the transfer is effortless and familiar. This method is typically only done for very small businesses. However, there may be tax implications, including potential gift taxes ranging from 18 to 40% if you exceed the annual gift tax exclusion, much higher than capital gains taxes from the sale transfer method. Because of this, you need to have your business appraised and file a separate tax return. This is another method that your accountant should be able to help you with. Then there's the Employee Stock Ownership Plan, or ESOP method. If you employ a lot of family members or even think of your employees as family, ESOP fosters employee ownership through a retirement plan by selling shares to an ESOP trust. It's a way to give back to your employees, but this method is unique and not widely adopted. While employees gain ownership, benefits, and tax-deferred savings, it can be expensive for you to set up. The process also requires extra effort in the form of additional reporting, tax filings, and annual company valuations. And finally, the trust method. This method is like a buy-sell agreement, flexible and user-friendly. You set up trusts that allow you to continue to own the business while you're alive, but you pass on ownership rights to designated family members when you're no longer around. Essentially, the trust automatically divvies up ownership among family members in the trust. While trusts allow tax-free contributions and a smooth way to transfer the wealth, they may also incur high trust taxes, up to 37%. When it's time for you to transfer your small business, keep it in the family with the help of an accountant. Now that you know about the 4 most popular methods, are you ready to check out accounting services and have expert advice moving forward? If so, consider CSI. To see if we can be a good fit for your business, click the link in the video description for a free consultation. Not ready to talk? That's okay. First, learn more about what it's like to work with CSI by checking out our website, also linked in the video description. And don't forget to subscribe to our channel for weekly small business tips. Thanks for watching, and see you next time.